If you're in a mission of mastering candlesticks and thus becoming a great trader, you are at the right place, because in today's video, we are going to learn about multiple candlestick patterns. Yes, hi all, welcome to the 24th episode of the complete learning series of stock market investing and trading. And as always, I put all these videos into a playlist. The playlist is available here in the I button. Make sure you watch all the videos in the right order and learn really well. Let's all trade together and grow together. So the agenda of today's video is very clear, because we have learned so far that if we learn about candlesticks, if we understand the logic behind candlesticks and the stories that the candlesticks are telling us, then it is for sure that we can all become great traders, right? And that's exactly what we are going to do in today's video. We are going to learn about multiple candlestick patterns. Cool? Then yeah, without further ado, let's get started. The name is Sharique Samsudheen. Welcome to Market Feed. So yeah, before getting into this video, there is one thing which I want to tell you, which is please make sure that you watch my previous video on single candlestick patterns. So in the last video, we talked about what candlesticks are, how candlesticks are formed, what is the logic behind candlestick, how candlesticks have actually stories that they want to tell you, understanding the stories that candlesticks are telling. All of the basic things regarding candlesticks we have learned in the previous video, the link to which I am giving here in the I button. Please make sure you watch that video, only then watch this video, because this video is a natural extension and continuation of that video. So yeah, I hope you have either already watched the video or you would go and watch that video and come back, right? So yeah, if that is the case, get into the comment section, mark your attendance, let's get started, right? So yeah, we are continuing our candlestick master class here. So the first question is, why multiple candlesticks? Why should we even look at multiple candlestick patterns, right? So to begin with, let's again have a quick revision of what we learned in the last video, and I'll give you an introduction as to what we are going to learn in today's video, right? So in last video, I hope you remember, we learned about a Marubozu candle. So that is a single candlestick. Just by looking at that single candlestick, we are trying to predict what can happen in the next time frame. Correct? So now what we are saying is, why are you just looking at a single candlestick? Are there opportunities or are there patterns where we can look into maybe 2 or 3 candles which come together and then form a pattern, and maybe that pattern together will help us predict what can happen in the coming 5 or 10 or 15 minutes? I hope you understand, right? In the last video, we learned how to look at a single candlestick and then try to predict what can happen in the future. In this video, we are trying to look at multiple candlesticks, maybe 2 or 3 candlesticks coming together, then forming a specific pattern, and that pattern probably telling us, hey, there can be bullishness in the next 10 minutes. Clear? So that's exactly what multiple candlestick patterns are. 2 or 3 or 4 candlesticks coming together, forming a pattern which is telling a larger story to us. Right? We learned in the last video, a single candlestick tell us some stories. Now maybe 2 or 3 candles coming together can tell us a larger story, can give us a even higher probability prediction of the future. Amazing, right? Then the question is, why not learn about that? And that's exactly what we are going to do in today's video. So yeah, we did learn amazing candlestick patterns in the last class. Again, make sure you watch the video, right? Now you can look at 2 or 3 candlesticks to identify a trading opportunity instead of just one. Instead of looking into just one candlestick, look into 2 or 3 candlesticks, which tell us a larger, better, high probability story, right? So yeah, we are basically leveling up by analyzing multiple candlesticks to make better predictions. Amazing, right? So as good technical analysts, in order to become better traders, that is what we need. We need better analysis or better predictions to be done so that we can take a better, higher probability trade. And that is how we will become better traders, right? So yeah, this is again a revision of what we learned in the last video, right? In the last video, we learned about single candlestick patterns, Marubozu, Doji, spinning top, hammer, shooting star. All of these single candlestick patterns we learned in the last video. In today's video, we are learning multiple candlestick patterns like engulfing patterns, Harami patterns, gap-based patterns, morning star and evening star. And again, do watch till the end because morning star and evening star are very common patterns which happen in a chart a lot of times, and I personally love a morning star and evening star a lot. So we'll be learning towards the end. Make sure you watch the video till the end, right? So yeah, let's get started. Let's learn the first pattern in today's class, which is engulfing pattern. So if you listen to the word engulfing, right? So what is the literal meaning of engulfing? Literal meaning, you go to Google, you search meaning of engulfing. What will it tell you? The literal meaning of engulfing is completely covering. Then it's very simple. So what then? Just by understanding that, what do you think an engulfing pattern mean? So this is just like how we did in the last video. Let's not read the theory first. Let's look into the image here so that we can understand what the candlestick pattern is telling us. Right. So as you can see here, there are two different types of engulfing patterns. One is bearish engulfing, second is bullish engulfing. So if you look into bearish engulfing, you can clearly see, right, there is one candle which has been formed and the next candle is completely covering the previous candle. And what is the word for completely covering? Engulfing. So if I may say, I can easily say that this large red candle or large bearish candle has completely engulfed the previous candle. So this is a bearish engulfing candle. Yeah, you understand that. Now let us try to understand the story here. What is actually happening here? So yeah, market was coming up, there is a green candle, everything was doing well. Then the next candle actually opened a gap up. That is the open of the next candle is actually above the close of the previous candle. Then what happened? Then large sell-off actually happened in the instrument. From here, lot of sellers got activated and less buyers, and selling, and the candle actually came down. What do you understand from this? The instrument was in an uptrend. It was still, even this candle actually opened higher than the previous close. But from here, large selling happened. And large selling happened to an extent where it completely covered the previous candle. It engulfed the previous candle. What does it simply mean? Some bearishness has kicked in. Correct. And that's exactly what a bearish engulfing candle is, right? Now let us read a bit of a theory and you'll understand what I'm saying. First is engulfing pattern is a two candle pattern indicating trend reversal. Correct? It is a two candle pattern, right? When two candles came here is when we could say it is an engulfing pattern. Fine. Second candle needs to completely engulf the first, right? That's exactly what we saw here. The second candle of the two candle pattern, the second candle is completely covering or engulfing the first candle, right? Now let's read about bearish engulfing pattern. It appears at the top of an uptrend. Correct? There was an uptrend. It was going up, and at the top of an uptrend, a new candle comes, which is the second candle of the two candle pattern, and that completely covered the previous candle towards the lower side. So candle 1, which is C1, is a bullish candle, and candle 2, C2, is a bearish candle long enough to cover and close below C1, and this is an indication that trend has changed, right? It is a two candle pattern indicating trend reversal. So when a bearish engulfing happens, you can kind of easily predict, or there is a high probability setup that this uptrend has come to an end. There has been a bearish engulfing pattern here. Probably from here there will be a trend reversal. The instrument can start moving down. Very simple. Now if you look at bullish engulfing pattern, is exactly the opposite that of a bearish engulfing candle. So if you read here, you can understand it appears at the bottom of a downtrend, right? The instrument is in a downtrend, then this C1 candle has formed, then C2 candle is a completely engulfing bullish candle. It is engulfing the previous candle, which is C1. That is why this is called a bullish engulfing candle. So when a bullish engulfing setup was formed here, we could say that the original downtrend which was there has come to an end and there is a trend reversal. Now the instrument can go up from here. Very simple. Now where can this help? If you're already in a long position, right? If you're already in a long position, then a bearish engulfing pattern is formed, then you can exit your long position. And I've seen traders who actually take a fresh short position also. Maybe that is not needed. I would say if you're in a long position and there is a bearish engulfing pattern forming, exit your long position. It is really, really safe. Just the opposite, if you are in an original short position and then a bullish engulfing pattern is formed in the instrument, then better exit your short position. Simple. This is how you can practically apply engulfing pattern. So yeah, now let us see an engulfing pattern actually in action. Let us go to a chart and see them in action, right? So this, as you can see, is ICICI Bank's 5-minute candles. Okay, so that is the point, right? Let it be single candlestick patterns, let it be multiple candlestick patterns. You can see them across asset classes, across instruments, and across time frames. It works across everything, right? So yeah, so this is ICICI Bank and this is 5-minute candles. So as you can see here there is a red candle and it's coming down. It's a slight downtrend here, and look at this green candle. It completely engulfed the previous red candle. So yeah, it is a downtrend, a proper engulfing red candle. So it is a bullish engulfing pattern. And what happened from there? See, either if you were in a short position here, you should have exited from there. Otherwise, market would have moved up and would have hit your stop loss if you had one, or if you would have gone into loss. Correct. Or else if you were in no position, a bullish engulfing pattern formed here, you could have even initiated a fresh long position here, keeping the low of the engulfing or low of the previous this red candle as the stop loss. What would have happened? It would have went up and up and up, and you could have probably booked your profit somewhere over here. Clear? Now, yeah, as we saw after this bullish engulfing, ICICI Bank is in an uptrend, right? It's moving up and up and up and up. And see what happened here. If you see here, there is a large red candle which is a proper bearish engulfing setup, right? ICICI Bank is in an uptrend, and then this red candle is large enough that it is completely engulfing the previous green candle. So this is a signal that if you initiated a long position here, you could have exited that long position here. Clear? So yeah, we clearly see examples of bullish engulfing and bearish engulfing patterns here. Very clear. If that is the case, then let us move to the next multiple candlestick pattern that we are learning today, which is Harami pattern. The name is pretty interesting, right? So the name actually, let's talk about the name since it is interesting. So the word Harami actually came from Japan, obviously, because the whole candlestick theory and the logic and the whole system was developed by Japanese, right? So if you see here, Harami is old Japanese for pregnant. Old Japanese for pregnant. So that's where if you quickly look into the image here, you can see that there is one candle and the second candle is well within the previous candle. And you can actually say that this looks like a pregnant candle, right? This one candle and the second candle is well within the previous candle, and if put together, you can kind of say that C1 is kind of pregnant with C2. I mean, just how the terminologies and the names actually came into be, right? Again, let us not even focus on that. Let us first, before reading the theory, like we always do, let us look into this and understand what has happened. So we can clearly see that the instrument is in a downtrend. And after the downtrend, what happened? The downtrend is not continuing, but instead, the next candle which is formed after the downtrend is a small candle with a small body, and it is well within the previous candle. What does this say? This says that the downtrend anyways is not continuing, which means that the sellers are not interested to sell more. But there is a large buying also, like we saw in the case of engulfing, which means that buyers are also not really interested in buying a lot and taking the instrument up. What does it mean then? You should be able to tell. It means that there is indecision here. So there is downtrend and then a small candle, which means that the trend is kind of coming to an end. Or there is a pause in a trend at least. That's what we can see here, right? It is again a two candle pattern indicating a trend pause and a possible trend reversal. Just a possible trend reversal, I would say. Now it was in a downtrend. C2 has formed, which says that trend has come to a pause. And from here, if the next candle actually breaks the high of C1, then I would say there is trend reversal. But what if the next candle after C2 continued to move down and broke the low of C1? I would say the trend actually paused with C2, and then now the trend is continuing with the next candles. Understood? So how do you think this candle pattern can be put to use? If you're already in a short position, if you're seeing C2 or if you're seeing a bullish Harami here, you can definitely exit your position. But in the case of a bullish engulfing pattern, when you were in a short position, when a bullish engulfing happens, you can, yes, definitely exit your short position, but you can always consider entering into a fresh long position also. But in the case of a bullish Harami, it is preferred not to do that. Yes, you can exit your original short position, but it is not really advised to enter a fresh long position, right? I really think that when there is a clear indication that there is a good trend reversal, that is when there are candles which break the high of C1, is when you should probably consider entering into a fresh long position. Super clear. Now, yeah, let's look into bearish Harami. You'll easily understand, right? There is an initial uptrend, then C2 candle is formed, and C2 candle is a small candle. It is well within the C1 candle, like C1 is pregnant, and this means that buyers and sellers are not clear as to what is to be done there, which means that there is indecision in the market, which means that there is a trend pause. Now let us quickly read the theory part of Harami patterns and then move ahead and see Harami patterns in action, right? So if you read about bullish Harami pattern, yes, it appears at the bottom of a downtrend. Obviously, it appears at the bottom of a downtrend. Candle 1, it is a 2 candle setup, right? So candle 1 C1 is a bearish candle, obviously, and candle 2 C2 is a bullish candle opening higher than C1 close and with close lower than open of C1. Again, when you read that, it is a bit lengthy and complicated. Don't get into that, right? All you have to understand is this candle is well within the previous candle and it has to be a small candle. That is it. And if you look into bearish Harami pattern, appears at the top of an uptrend. Yeah, it appears at the top of an uptrend. Candle 1 is a bullish candle, obviously, and candle 2 C2 is a bearish candle. It is a bearish candle opening lower than C1 close. C1 close is here. This opening is here, and with close higher than C1. Close is higher than C1. It basically means that the second candle is a small candle and it is formed well within the previous candle, right? And how to infer, what to make sense of it, what are the stories that the bullish or the bearish Harami patterns are telling us, all we have understood. How to practically use them, also we have understood. If that is the case, let's move ahead and see Harami in action, right? See, here we have a bullish Harami in picture. So there is an original downtrend here, and at the end of a downtrend we have a bullish Harami. As you can see, the body is small and it is well within. The open is above the previous close and the close is below the previous open as well, and it is well within the previous candle, which means that there is indecision in the market. You could have, if you were in an original short position, you had to exit there and do not enter into a fresh position. Probably wait for confirmation, right? Whether there would be a trend reversal or there would be trend continuation towards the lower side. How would you confirm that? You would wait and you can mark the high and the low of this previous red candle C1 of the Harami pattern, and if the high is taken out eventually, then you can enter a long position. If the low is taken out eventually, then you can enter a short position, right? What happened here? The next candle actually took out, it broke the high of this red candle, C1 red candle, right? So that is where you could have probably then entered into a long position, keeping the low of the bullish Harami setup as the stop loss. What would have happened? The stop loss wouldn't have hit and you would have gone up and up and up and you would have made money. Amazing. Cool. Now you can see a bearish Harami pattern here. Obviously market is in an uptrend. The instrument is again IndusInd Bank and the time period is 1 day here. Okay, I've taken a different time period so that we can learn everything, right? So yeah, IndusInd Bank is in an uptrend here, and after this uptrend, this very good green candle, we can see what happened here. There is a small red candle well within this previous green candle. And what is it? It is a bearish Harami setup. What could you have done? If you were in a long position here, you could have exited your long position, right? And then when would you enter a new position? Only when the high of this green candle, or the low of this green candle is broken. You could clearly see here and take a position accordingly, right? As you can see here, eventually the high was taken out. You could have entered into a long position, keeping the low of this candle as your stop loss. You could have made money. And again, I'm not saying you could have made money. Maybe even after having a proper setup, you might end up taking a position, losing money also. I keep re-establishing this, right? There can be a proper pattern and that can give false signals as well. And you have to accept it. So the whole point is finding high probability setups, right? So when you are looking at patterns and you're taking trades, when you're taking 10 trades, maybe at least 6 or 7 times you have to be right. 3 or 4 times it is okay to be wrong also. And when you're right 6 or 7 times, you make good money. And when you're wrong 3 or 4 times, make sure that you do not lose much. That is enough to make money in the market. That is enough to make money from trading. I hope this is really confidence inspiring. Amazing, right? Moving ahead, let's learn the next pattern, which is gap based patterns. Now this is something very common in the market, and I normally see a lot of doubts among a lot of beginners as to, they look at Nifty. They look at Nifty and see that one day Nifty closed, for example, at 17,500. They see the next day Nifty opens at 17,600 and there is a gap in the chart. And they ask me why this gap is caused. And that's exactly what we are going to learn now, right? We are going to learn about gap-based patterns. So as I said, a lot of you would have already seen a gap up or a gap down opening, especially in Nifty. And one thing which is interesting is what we can read here, right? Gap up opening and gap down openings occur in the market mostly overnight. Right, that is on a day candle is where you can prominently see big gap ups and gap downs among candles. Yes, they do occur in a 5-minute time frame or a 10-minute time frame also, but it is very difficult to find them on a 5 or a 10-minute time frame, especially in very liquid contracts like your Nifty or big companies, right? But if you look at a daily time frame, daily candles, you can see them a lot. Now let us understand about gap-based patterns. It's very easy. Before reading the theory here, let's look into the images and understand this, right? So the first day's candle is a good green candle, or let it even be a red candle. And what happens the next day? The next day's open is much higher than the previous day's close. One day has closed here, right? Nifty, for example, is 17,500. Next day's open itself is 17,600. Then obviously there would be a gap here, and the next day opened at 17,600, it went up to 17,700 and closed like this. So the previous day's candle is like this, the next candle like this, then there would be a gap here, right? And this is called a gap up, a gap being created on the chart. So as you can see here, this is the first day, it's a green candle. The next day's open is well above the close of the previous day, and the next day also moved up and closed above. So here a gap up has been formed. And what does this indicate? You tell me. This day there was buying in the market. Why does a gap up occur? Because on the next day there is so much buying in the market. So there is something called pre-market opening, right? And that is the time where even before Nifty has opened or even before NSE has opened, you can put in your AMO orders, other people or big institutions can put in their order. All those orders are matched and the new day's opening price is discovered. And if in this pre-market, if there is a lot of buying happening, then obviously the price discovered for the next day's opening would be higher. High demand, low supply, obviously price would be higher, and that is why the next day there is a gap up opening. And obviously the next day also market has moved up. What does it say? There is high demand in the market. What does it mean? There is good buying in the market. It is a bullish market. As easy as that. So gap up opening is a bullish indication mostly, right? At least the phenomenon of gap up. See, on 9:15 a.m. on a day, if you see there is a gap which has been created, it is indication of bullishness. Maybe after that, the Nifty or whatever instrument, the gap up has occurred, it might come down, but the phenomenon of a gap up is indication of bullishness. Only because there was a lot of buying happening, a gap up is formed. Clear? Cool. So indicates buyers are very enthusiastic and confident to buy at higher price than yesterday's close. That is the whole logic behind gap up. In fact, I've taken some more time out and I've explained about how gap ups and gap downs are formed, and that you can find in this video up above, right? Now the next one is a gap down opening. It is a bearish indication. So if you see here, one day has closed here and the next day's open is well below the close of the previous day, and that is a gap down opening. Why does it form? Because lot of people selling in the market, lot of sellers, very less buyers. Sellers have enthusiasm, buyers do not. That is the reason why gap down openings are formed, and that is a bearish indication. Indicated or indicates sellers are very eager and confident to sell at even lower price than previous day's close. Very simple. Now this is a very common pattern that you can find especially in Nifty, Bank Nifty on a daily time frame, and yeah, you can definitely put them to use. Cool. Let's move ahead. There is no use of going into a chart and looking at gap up and gap down in action, and that's exactly why we are going to learn the next candlestick pattern, which is one of my favorites, a morning star pattern. So far we've been learning about two candlestick patterns, right? If you look at engulfing pattern or a Harami pattern or even gap up or gap based patterns, all of these are two candlestick patterns. Now we are moving ahead to learning three candlestick patterns. The first one is a morning star pattern. Now let us clearly look into what a morning star pattern is, right? So yeah, clearly it is a three candlestick pattern. So there was the instrument was clearly originally in a downtrend, and the final downtrend candle is C1. Then a small candle is formed, and that is opened with a gap down, and it is more like a doji or a candle with not much of a large body. What does it show? Indecision. What does it show? Very simple. We have been learning this for a good enough time period now, right? What does the C2 indicate? C2 indicates that there were a lot of sellers selling relentlessly in the market. When C2 is formed, it means that sellers do not want to sell a lot more. And C2 also indicates that buyers also don't want to buy a lot more. If buyers were buying a lot here, then this would have been a larger candle. Maybe even be an engulfing candle. So C2 indicates that probably there is a pause or a pause to the trend or probable trend reversal, but it is not clear. C2 indicates that the trend is coming to a pause. Then forms a third candle, because Morningstar is a three candlestick pattern, right? So the third candle C3 has formed. And what is interesting in C3? C3 indicates that there's a lot of buying happening in the instrument after C2 forming, and after this buying, the high is or the close of the C3 is above the open of C1. What does it indicate? Buyers have activated to such an extent that there is a probable trend reversal. Correct. So a Morningstar pattern, if you think about it, it appears at the bottom of a downtrend. So downtrend happening, bottom of a downtrend, C1 has formed, which is a red candle. Then comes C2, which is kind of rejection, which kind of tells us that, okay, the downtrend is probably coming to end or probably taking a pause. Then comes the next candle, which is a very large green candle, which engulfs even C1, which means that now there is a proper trend reversal, right? So rather than engulfing candle forming in the market or a Harami pattern forming in the market, the chances of a morning pattern forming in a chart is higher. That is why I like it. And the probability that this can win is also higher. That is the reason why you should definitely look for a lot of Morningstar patterns, right? So candle 1 is a red candle, bears are strong. Candle 2, gap down, bearishness, then a doji. So it necessarily not be a doji. It can even be a candle with a long wick on the lower side but a small body. It is fine. And candle 3 is gap up and green candle closing above C1. Very clear. So what do you do here? If you were already in a short position, you see a morning star, you can exit your short position, you can initiate a new long position. Yes, you can do that. Cool. So what I would originally do is, if I am in an original short position, by seeing C2 itself, I'll exit my short position. Then I'll wait for, if C3 is forming, then yeah, good, I'll enter a new long position. But if there is a larger red candle forming again, which is breaking the low of C2, then I'll probably enter a new short position also, right? See, you might see me going away from theory a bit also, because as I always tell, candlesticks are all about understanding what is happening and reacting to it. You need not learn the theory, the names exactly. Oh, C2 should be a doji. The C3 should open with a gap up. No, even if C3, if it's not opening with a gap up, I would still call it a Morningstar pattern. Do you understand me? So it's all about understanding, looking at it and understanding what the candlesticks are telling us. Anyways, now let us look into Morningstar in action. So here it is originally in a downtrend. Look at so this is your C1, this red candle is your C1, a beautiful rejection C2 candle, which is a doji, we could say, right? It is, there are wicks on both the sides and there is a small body as well here, or you could even call this a hammer. It is fine, right? You could even call it a hammer, but it doesn't matter you call it a hammer or doji is my point. You understand the fact that sellers are selling, and here buyers have activated, there is indecision, and then this is clear buying. When the high of C1 is crossed, you could probably initiate a new long position. What would have happened? You would have made a good amount of money, right? High probability money. I'm just saying it is just high probability. Now that I had to select a case and put it into the presentation, I just showed a case where money is actually made. There will be setups where you will lose money as well, just being super realistic here. Cool. Now let us learn the last pattern we are going to learn today, which is an evening star pattern. Exactly the opposite of a morning star pattern, right? See, the instrument is originally in an uptrend. C1 as the last candle of the uptrend. Then you see a small candle forming here, which is a rejection candle, which says that buyers are not interested in buying anymore and sellers are also not really enthusiastic to sell. But then forms a C3 red candle, which actually closes below the open of C1, which says that, okay, buyers have completely have been exhausted and sellers are super enthusiastic to sell now. Amazing, right? If you were in a original long position, you could exit your long position and you could probably initiate your fresh short position here, That's exactly what an evening star pattern is. We can quickly look into an evening star in action, right? See, the instrument is originally in an uptrend, and see what happens here. Beautiful, beautiful shooting star, I would say, right? This red candle, which is a C2 of this evening star setup, is actually a proper rejection candle. What is the story here? Buyers tried to take the instrument up, but then sellers got so activated and buyers got not very enthusiastic, right? And look into the next red candle and the next red candle. See here, right? This evening star consists of 1, 2, 3, 4. This is a 4 candlestick pattern. We learned that evening star is a 3 candlestick pattern, but now I am showing you example of a 4 candlestick pattern. That is where, my dear student, I am saying that it doesn't matter if it is a single candlestick, 2 candlestick, 3 candlestick, 4 candlestick, 5 candlestick pattern. What you have to understand is what the candles are telling you. Right? That is what you have to understand. And if you understand, the day you start understanding that, you'll become a good trader, you'll start making money. And that is how I would end today's class. Understand candlesticks with your heart, and then you wouldn't need names, you wouldn't need theory. You will start understanding. You'll start understanding what charts are telling you. You'll be just market opens at 9:15 a.m. Your friend sitting in front of charts, and you'll feel that charts are talking to you. Reach that point, you'll become great traders. So yeah, that is it from this video. So I think this was a 2-video series, a quick series where we learned about charts, candlesticks, patterns, and how they would talk to you so that you can become a good trader. If you've liked them, make sure that you smash the like button, get into the comment box, talk to each other, ask me doubts. I'll make sure that I'll reply to each and every one of your doubts. And also, if you did not know, I also host a private community, exclusive community on MarketFeed app. The link to join the community is also given in the description and in the pinned comment down below. So make sure that you join the community as well. And as I always say, share this video and share this wonderful learning playlist with as many as people as you know, and invite them to join this amazing learning, growing, trading, profitable community, right? So yeah, that is it from my side in this video. As always, let's all learn, trade, invest, and grow together. See you in the next class. Bye-bye.